Right, well, in the studio today, I've got one of my favourite people, and it sounds pretty weird, doesn't it? But I love these guys at RP Data. It's Tim Lawless. He's the head of research for RP Data. Welcome, Tim.
G'day, Anthony. Great
Tim,
to be here.
Your first time in the studio.
Yeah, first time here. Normally I'm dialing in from Brisbane, so yeah, it's fantastic.
Well,
to be
thanks
here.
for calling in for this exclusive interview.
Pleasure.
Now, Tim, before we get into the real estate questions, this is my opportunity to find out about you. Where were you born? You got family, kids? What's going on in your life?
Oh man, well, where was I born is a long story. So I was born in Taiwan, in Taipei.
Is that right?
And yeah, we moved from Taipei to the Philippines, to Holland, to Australia, to America, then back to Australia. So right back here in '84, and I've been in Brisbane since about '85.
So what is your nationality?
I'm Australian. My mum and dad are Australian, and yeah, so.
So what did your parents
Australian.
do?
Dad worked for Philips, the electronics
Yeah.
company. So he was selling medical equipment for Philips and setting up offices around the world. I've got two young kids, Finley and Madeline. They actually turn 7 and 5 on the weekend. So we've got this coming weekend. So we've got Laser Force on the Sunday and a pool party on the Saturday. So yeah, good.
Fantastic. And Tim, you've flown all over the country all the time. It's really hard to sort of catch you. You're a busy boy. What's who pays? How does it work?
Yeah, well, we do a lot of engagement with the industry. So all the industry groups, the MFAA, the API, UDIA, the Property Council, and we speak to a lot of our clients, people like TOOP+TOOP, and try to give them the best understanding as possible of what's happening in the housing market and the commercial market. What are some of the economic drivers, the demographic drivers? So yeah, it's really going around the country talking to people about what our data is telling us about the economy and about the housing market.
So Tim, just on that, are you an economist or are you a statistician, or what would you say your background?
Bit of a jack of all trades in many ways. So yeah, my formal degree was in information management and in business. And doing this sort of role for the last 16, 17 years, I've had a lot of exposure to economics, to demographics, and mostly to residential housing markets. So yeah, we sort of, both Cameron Kusher and I, our senior analyst, comment on pretty much anything that's related to property.
Both you and Cameron are on the TV all the time, so there's obviously big demand for what you're doing.
Well, the housing market in Australia, it's barbecue conversation, it's boardroom conversation, and everything in between. So there's a lot of interest about the Australian housing market.
So just a matter of interest. So you go to a dinner party. Do they absolutely grill you? Is that what happens?
Yeah, pretty much.
Yeah, okay.
Yeah, absolutely.
Cool. Now, let's move into perhaps you mentioned all of these people that you act for. What fascinates me most is the Reserve Bank. So do you literally speak with them, or do they just get reports from you?
A bit of both. So the Reserve Bank subscribes to a lot of our indices, the RP Data Rismark indices, for example, which most of the economic community subscribes to also. Everything from auction clearance rates to the number of listings, transaction volumes in the marketplace. We pump all that data into the federal government, not just the RBA, but also into Treasury, into FAXIA, into Department of Housing, and at state levels as well. So it's certainly used for decision making, for policy implementation as well. And of course, that funnels all the way down through to state and local government, and then through the industry as well.
So I'm assuming the Reserve Bank's a bit more organised than the actual government, with all the stuff been going on the last week or so?
They're a pretty streamlined machine in there. There's some smart people in the Reserve Bank.
Okay, now Tim, and there's a lot been going on, obviously, with interest rates, and you're obviously important in that decision-making process for the Reserve Bank. Can you explain to me what you think is going to be happening with interest rates?
Absolutely. So if you asked me that a month ago or 2 months ago, my answer would have been much different. I would have said, well, probably due for another 25, potentially even 50 basis point cut in the cash rate. What we're looking at today, though, is we've had a really positive raft of data flowing through. We've seen a really strong jobs figure come out earlier in the month. We saw
that was completely unexpected, wasn't it?
Completely unexpected, and it's certainly thrown a bit of a curveball for a lot of economists who thought that the jobs creation would be a lot lower, the unemployment rate would probably tick up by now. What we've actually seen is unemployment steady at 5.4%. We saw 71,000 jobs created over that 1 month alone, which is the highest level of jobs creation since 2000. Okay, so let's see how it gets revised. So the month-to-month figures are a bit volatile, but I think the consensus now seems to be we may have one more rate cut in the cutting cycle. Potentially we're already at the bottom of the interest rate cutting cycle. We're starting to see fixed rates rise now, so a lot of people are starting to fix in at those very low fixed rates. Variable rates will probably stay low for some time, But even though we are at the bottom of that cycle, it doesn't necessarily mean we're about to see interest rates start rising rapidly. I think that's still a long way off. We are going to be seeing a low interest rate environment for the foreseeable future.
Right, okay. And so the 4.99% that CommBank and that, those loans, those rates, if you were at your barbecue talking with friends and they said to you, look, what do I do, Tim? Would you say?
I'd say fix.
Fix.
Personally, we have just fixed. So for one of our investment properties that's come up for renewing our finance, we've just fixed into a 2-year fixed loan, and we've prepaid the interest as well to get an even lower rate, because I think it's going to be going up from here.
So what rate did Tim get?
I won't say exactly what it is, but it's in the mid to high fours. So yeah, 4%.
Right, so 4.7.
Yeah, about 4.7,
Right.
4.8.
Okay.
Yeah.
So how did you negotiate that, just for those listening?
Well, it was between two banks, and we bank with one of the big four, and one of our investment loans is with another of the big four. And we're considering going to the other bank, and we approached our bank and said, this is what we're thinking about doing, and they came to the table. So it's pretty competitive out there. And I can encourage anybody who is looking to set a new interest rate or get a mortgage, absolutely speak to your bank frankly and see what the best rate you can get is.
So when you had those conversations, there was no negative reaction. It was just, no, we want to save your business, Tim.
Absolutely.
Yeah.
It was a courteous conversation.
Yeah.
It's
Because the thing that is noticeable at the moment is a lot of people are not getting loans. So presumably the banks are looking after one category, and they're really distancing themselves from anything marginal.
Well, probably a better way to put it is the banks are very risk averse now, and if you're a risky proposition, it's going to be really hard to get finance. Having a deposit, having some collateral is really important in this particular environment, and the banks simply aren't going to take a risk.
And the first time in years I've heard the comment, we haven't seen a savings program or a savings pattern, and that was impacting on one that I was dealing with during the week. Now, I haven't heard that terminology for 15 years.
Yeah, well, just look at some of the figures. The household savings ratio now is up at more than 10%, which means households are saving more than 10% of their income. Go back to, say, 2005, 2006, it was in the slightly negative, meaning we were spending more than we're earning. And we've seen a real turnaround in saving patterns.
But the banks have actually put credibility on a savings pattern before they'd look at this person to lend them the money.
Absolutely.
Yeah. So now, Tim, property. Let's go. So globally, let's start globally.
Okay, globally, so pretty big picture. We're seeing in all the countries that Australia's in the reference group, we've seen the US, for example, values are now up by 9.5% since they bottomed out. So the US housing market's turning around. UK, pretty flat property market. We're seeing some growth around some areas. Absolutely, that market's bottomed out as well after values fell by around about 25%. US was down by 33% from peak to trough. New Zealand, it's going gangbusters. So mostly driven by Auckland and Christchurch with the rebuild going in through Christchurch. Canada's been
Why would you rebuild?
Well,
I mean, that's easy to say when you don't live there, but I find that really bizarre.
Well, you need to rebuild the infrastructure, you need to rebuild the city core, but a lot of the housing supply is simply gone now. So it's the outer fringe of Christchurch where there's a lot of people who are relocating, obviously, a lot of demand in those areas, not a lot of dwellings, and also the influx of workers is really driving up prices in those areas. The other country is Canada, and we've seen Canada very similar to Australia in the sense a lot of stuff in the ground that they extract and export. The Canada housing market has been going just ballistic, and for the 6th consecutive month now we've seen Canadian prices fall. So it looks like that market's going through a fairly late correction after some pretty strong growth.
Right, so by the way, I had an email through yesterday from a lady that we met in the States, and her headline was market lifting 20% lift in and out. That's probably sensationalism, but she's saying in her email that they've seen the dip and now it's very much on the rise.
It's on the rise. Unemployment's falling as well, which is a great sign. So the American economy, it's not as much of a basket case as it used to be. It seems to be out of the woods, but still some ground to recover before there is a technical recovery. You know, we still need to see values rise by more than 25% before they're back to where they were in 2006, which is when the US housing market peaked.
Yeah. But at least they let it crash and burn and anyway. Now, Australia.
So it's been a very resilient market here, though we are coming out of a correction. So we saw values fall by around about 7.5% from peak to trough. And the bottom of the market, based on our index, was on the 31st of May last year. Since since June through to the end of February, we've seen values rise by around about 2.5%. And 2013 is starting off pretty strong. So we've seen auction clearance rates get up around the 65% mark across the combined capitals average. Sydney and Melbourne even a bit stronger. They're the two largest auction markets. Homes are selling a little bit faster. Transaction volumes rose by about 7.6% over the second half of 2012. So some pretty good signs. We still need to see values rise by another 4.5% before they're back to where they were at November 2010, which is when our local market here peaked. So we're seeing a recovery underway. It's going to be gradual. We're not expecting any double-digit growth, for example, for quite some time, but it's certainly heading back in the right direction. We're seeing consumer confidence really quite high now, the highest been since December 2010. So we are starting to see consumers come back. There's confidence in the housing market. Interest rates are low. Affordability is much better than where it was back in 2009. It's back to where it was in about 2001, 2002. So some pretty good signs out there, but you know, it's still early days, and it's going to take some time for a technical recovery to be in place.
Now, South Australia?
South Australia, a little bit different. So we've seen most capital cities are recovering. South Australia is as well. Adelaide values are up about 1.5% since they bottomed out in June, July last year. But when you look at the transaction volumes here in Adelaide, they haven't increased like we have seen in, say, Perth or in Brisbane.
I feel the pain because real estate agents actually are most affected in their business, not in terms of their client, but by volumes, and the volumes.
Absolutely. Yeah, well, it's not just real estate agents, it's the finance sector as well. If you're not seeing property turnover, then you're not seeing new mortgages. It's white goods, it's home furnishings, it's building materials, and it's real estate agent commissions, of course. So there's a real multiplier effect from the housing market when we see transaction volumes running as low as they are.
Yeah.
Stamp duties, state government, absolutely. So transactions in Adelaide running around about 15% below the 5-year average at the moment. Very stable, so we're not seeing transaction volumes dipping away anymore, but they're certainly stabilised at a fairly low level, and we're yet to really see an uptick in that buyer activity coming back into the local market.
Now, Tim, a question as someone in the, I'm in the trenches, like actually seeing people and at auctions, negotiating reserves, and why is it that there still seems to be, we operate mainly in the middle to top end, why does it still seem to be anecdotally way more than 7 or 8% off what it was? Is that because the bottom end's picked up?
Well, the top end, the market you operate in, so the upper mid market, the top end market, actually did see a much larger decline. Values were down by more than 10% from peak to trough. Yeah. It is actually the top end and the higher middle end that is starting to respond a little bit better now to current market conditions. So we're starting to see that market, even though it did correct more, it is starting to show a faster recovery. So when you break Adelaide down by 3 broad price bands, so the top 20%, we've actually seen some year-on-year growth in that market now, as subtle as it is, whereas the bottom end of the marketplace is still relatively depressed and fairly soft. So we are starting to see some interest coming back at the top end, but when you're on the ground, it's really hard, I suppose, to take a step back and look at the marketplace from that overall view, which is what our indices show. When you start drilling down and when you start looking at individual suburbs or postcodes or regions around the city, the performance of the market can actually be quite different. And being on the ground in the trenches, as you say, you've got the first-hand experience, and sometimes there's a bit of a disconnect.
We're certainly seeing some areas and even streets just going gangbusters, and then around the corner, less than a kilometre away, it's like a different market. So there's quite odd things happening, but I think as the market starts to lift, that'll all even out.
Absolutely, and for anyone looking to buy, it's a big decision to make a property purchase. It's probably one of the biggest decisions anyone ever makes. And the most important thing you can do is research, because you can look at the headlines, you can look at the media. What you're reading there is headline statistics and macro views of the market. There's no substitute for getting down below the surface, peeling back those layers of the onion and finding out what's happening in a particular micro market. Because as you say, they can be operating quite differently.
Now, a favourite question, I know we're over time, but I'm going to keep this going. A favourite question of mine is about our Fleurieu, right, which is the south part. I am of the view that that's underpriced and it's been smashed. It's been really hurt. Any thoughts on that?
Yeah, I don't know it as well as I do my local market, but it really depends on our transport connections decent coming out of there.
Well, the brand new freeway is the Southern Expressway is being duplicated, which is
well, that's a good sign.
In the first time around, but it's very exciting. That'll be finished probably within well within 12 months, I'd say.
Okay, well that's a really good sign. So if you think properties down there are undervalued, there's a lot of new infrastructure coming in that's going to connect to the major working hubs and nodes around Adelaide. It's probably a bit of a gold mine. Time and time again, if you look at any major infrastructure project that happens in the outskirts or the fringes of a city and provides better connectivity and cheaper home prices, then generally speaking, capital growth tends to follow.
A classic was the tunnel that went through and connected the hills, basically Adelaide through to Crayford Stirling, and we had an immediate lift, and they've basically become, their whole price structure just incrementally shifted with that tunnel.
Yep, and there's examples all around the country. The new M1 that went in between the Gold Coast and Brisbane, for example, back in 2001 or 2002, just saw the Gold Coast market completely opened up.
Tim, we've got more questions, but we're just going to go and see a little bit more about the property market.
Okay.
So let's go to Going, Going, Gone.